welcome back. In this video, we're going to talk about IAS 36, which has to do with impairment. So let's start. So impairment is when the carrying amount of your asset, which is shown in your balance sheet, is more than the recoverable amount that you will get through continuing the usage of that particular asset or selling it in the market. So basically, in your books, you have somewhat overstated the asset than its actual value. So you have to bring it down to its actual value, which is called the recoverable amount, and this is called impairment. So next, how do we measure if there is impairment? And if there is impairment, what is the amount to which the asset is impaired? So basically, we know that impairment happens when the carrying amount or its book value is greater than its recoverable amount, or the amount that we're going to get either through selling it or through continuing the usage of that asset. So we only need to see what recoverable amount is. So recoverable amount is the higher of fair value less cost to dispose and its value in use. So fair value less cost to dispose is market value less whatever expenses that you need to get to sell your asset, and value in use is the present value of the future cash flows of that asset. So your asset will generate cash inflows and cash outflows. If you discount these cash inflows and cash outflows to today's terms using a discount rate, then this will be your present value, and this is what is called your value in use. Now, if we think of it logically, your fair value less cost to dispose is how much you will get if you go to the market and sell it right now, and your value in use is how much you will get if you continue the use of your asset in your everyday business, because that is the amount of cash inflows and cash outflows that you're going to get because of this asset. So you logically will choose the option which is more beneficial to you, so which is higher. So if going and selling it to the market is going to be a better benefit, you will choose that. Or if you are choosing to continue the usage inside your business because the cash flows that it generates is higher, then you will choose that. So the higher of these two options will be your recoverable amount, because this is the amount which you are expected to recover through either the usage or the sale of this asset. So this recoverable amount is then compared to the carrying amount. And if this recoverable amount is lower, which means that its value is actually lower than in the books, then there is impairment. Now, if your recoverable amount is lower than your carrying amount, then it means that impairment has occurred, and this impairment should immediately be recognized in profit and loss. Exceptions to this case. So if the asset which has been impaired is previously a revalued asset which has a revaluation reserve, so which means that your asset has been revalued, a revaluation surplus has been created and has gone to the OCI, and there exists a revaluation reserve for this particular asset. Now, if this is the case, then your impairment should be set off against your revaluation reserve, and any excess should be taken to your profit and loss account. If the asset is not a revalued asset and it does not have a revaluation reserve, then you have to directly take it to your profit and loss account. Next, when there is impairment, your asset will be brought down to its recoverable amount, and so now it will have a new amount in your balance sheet. It has been decreased. So any further depreciation charges or estimated residual value has to be estimated with this new amount, and its old amount will cease to exist. That is not relevant anymore. Now let's look at a sum. I don't want to waste time by reading the sum because this is a pretty big sum. So please pause the video, and then after you've read the whole thing, resume it again. So I'm going to give you some time here. So hopefully you've read the question. If you have not, then I really don't have anything to say. Anyways, let's look at the answer here. So this question, they've asked you two things. What should be the value of the drilling platform in the statement of financial position, and if there is any impairment loss. So if there is any impairment loss, we have to first compare our recoverable amount to our carrying amount. So the carrying amount, they've directly given it as 3 million. Now our recoverable amount is the higher of our value in use and our fair value less cost to dispose. So our value in use will be the 3.3 million, which they have directly given is the present value of estimated cash flows from platforms continued use, and we have to reduce 0.6 million because this 3.3 million is not adjusted for dismantling costs, and dismantling costs, as we saw in our previous standards, is something which we have to incur when we are taking apart the asset after we've done using it. So this will also be a cost for us, and so we have to reduce it from our cash flows. So our present value of cash flows will be 3.3 million minus 0.6 million, which is 2.7, and this will be our value in use. Next, we have our fair value less cost of disposal, which they have directly given as 2.8 because they've said that the company has received an offer for 2.8 million from another oil company, which means that is how much it's worth in the market. So the greater of these two amounts is 2.8 million, which is 2.7 million value in use versus 2.8 million fair value less cost of disposal. So its recoverable amount will be 2.8 million. Now compare this to your carrying value and you can clearly see that its recoverable amount is less than its carrying value, means that the assets stated in your books are overvalued. Now you have to bring it down to recoverable amount. So your impairment will be carrying amount less recoverable amount, which is 3 million minus 2.8 million, which is 0.2 million, is your impairment loss. Now the asset will now be taken or written in your books as 2.8 million, and this is the amount which will be shown on your statement of financial position from this day forward. Right, so next and the last topic that is really important in impairments is something called as a CGU. A CGU is a cash generating unit, and this is the smallest identifiable group of assets which produce cash flows, which means that it can be any department, it can be any branch, and it consists of a group of assets which produce cash flow. So what we do is we find out the recoverable amount for the whole of the CGU, that is a lot of assets inside it, the whole of it, we will find out the recoverable amount, compare it with the carrying amount, and if there has been any impairment, we will allocate it proportionately between the assets inside that CGU. Now, an important thing to note about a CGU is that goodwill by itself cannot produce any cash flows. And if you think about the statement, it's just logical because goodwill is intangible, and you cannot just directly say that because of goodwill, this much cash flow is coming into my business. So what you will do is you will allocate this goodwill to relevant CGUs by how much benefits they're receiving because of this goodwill. For example, if you're acquiring goodwill through a business combination, then this business combination will produce synergies, which means the benefits of being combined as two businesses instead of operating as one. So this synergy, how much it benefits your particular department or particular branch or whatever CGU, that much amount of goodwill will be allocated to that CGU. Since goodwill cannot produce its own cash flows, you will allocate it to different CGUs based on the CGU's use of that goodwill or benefit it derives from that goodwill. Now jumping back to impairment and CGUs, once we have found out that the carrying amount of the whole entire CGU is more than its recoverable amount, impairment has incurred for the whole CGU. Now this impairment has to be allocated between the assets that are present inside the CGU on the following basis. First, we will give impairment to any particular assets which are obviously damaged or destroyed. So if in the question that they've given that this particular asset has been damaged or destroyed, then obviously it means that it has gone through impairment, so any particular assets come first. Then we will give it to goodwill of the cash generating unit. Then we will give it to all the other assets on a pro rata basis, means the proportion of their carrying amount. So first to any particular assets, next to goodwill, and then next to the remaining assets on a pro rata basis. This is the way that you allocate the impairment loss which has happened to the whole entire CGU to the assets inside the CGU. So let's look at a question for allocation of impairment to CGU. So please pause the video and read the question and then resume. Okay, so hopefully you've read. So they're saying that the total carrying amount of your cash generating unit for your building, which comprises of building, plant equipment, goodwill and current assets, is 66. Following recession, it has come down to the recoverable amount has come down to 50, which means that the carrying amount is more than the recoverable amount, so that 16 will be your impairment loss. So now this 16 we have to allocate it between all of the assets in this CGU. So first, as per the rule, we have to give it to any particular assets, and here they have not specified that any asset has impaired in particular, so we're going to leave that. Next, you will give it to goodwill. So 10 of the 16 will go to goodwill. Goodwill will afterwards be 0 because it is only 10 and we're giving 10 to goodwill. So now goodwill after impairment will be 0. Next, we will allocate the remaining 6 between building and plant and equipment on a proportionate basis to their carrying amount. So the total of building and plant and equipment is 36. So 30 by 36 into 6 we will give it to building, and 6 by 36 into 6 we will give it to plant. This is just the proportionate carrying amount value of the two. So impairment loss for the building will be 5 and impairment loss for plant and equipment will be 1. So after impairment, your carrying value of all your assets will be building 25, plant and equipment 5, goodwill will be 0 and current assets will be 20. No impairment on current assets. So the total of your CGU will be brought down to its recoverable amount of 50. Now lastly, we'll look at indicators of impairment, which means if one of these situations has come to arise in the business, then you will have to check your asset to see if it has been impaired. Now these indicators can be categorized into two. One is internal sources of information and another one is external sources of information. So internal sources is whatever you can gather from inside the business, example physical damage, evidence of the obsolescence, adverse changes in the use. Once you change the use of an asset after it's been doing what it does for a long time, it might adversely impact it. So next is decrease in assets economic performance. So if over and above the general passage of time, if you see that your asset has been decreasing in economic performance, then this may be an indicator that it has been impaired. Next, coming to external sources of information, a significant fall in the asset's market value more than expected. So since we're comparing its fair value since we're comparing its recoverable amount, and its recoverable amount comprises of fair value and value in use, if there is a fall in the asset's market value, then it means that the fair value has reduced, and so the recoverable amount has also reduced, which can in turn make way for impairment. Next is a significant change in the technological market, legal or economic environment, basically a change in the economic environment. So we have learned in business that the business atmosphere or the environment is changing constantly, and if we cannot keep up with this change, we get left behind and we may lose value, and this is what they're talking about. So we have to see if there's any significant change, and because of the significant change, if we have lost value as a firm. Next is an increase in market interest rates or market rates of return. Market rates of return is what we have incorporated in our discount rate when we are finding out the present value of future cash flows. So more the discount rate increases, the less will be the value of the present value of the future cash flows. So once this value in use decreases, then the recoverable amount also has chances of decreasing, and so it might be impaired. Last but not least, the carrying amount of the net assets being more than its market capitalization. Your market capitalization is the total amount of ordinary shares that are inside your business multiplied by the market price per share Oh my god, there's a kid chumma ringing the bell somewhere. Yeah, it's the where was I? Market capitalization is market value per share into number of ordinary shares. So basically, this is the value that the market has for your company. So there's a market value of your company. And then, okay, if there's no kids, then it turns out there are birds. Never mind. The carrying amount is the value of your business inside your books. So if the carrying amount in your books is higher than what the market perceives the value of your business to be, then this might indicate that there has been some kind of impairment. And that is all for indicators. So that's all you need to know for this chapter. Go through the sums and you'll find it a little bit easier. And what I wanted to add is that if you guys want the PowerPoint presentations that I'm using, then you can directly ping me on Instagram. Oh, stupid kid. You can directly ping me on Instagram, or you can comment it in the section below with your email ID or something like that, and I can give it to you. So that's it, and thank you so much for listening, and I will see you all in the next video. And please do take care. Bye-bye. Don't let Corona get you.